Good morning, everyone. It is Wednesday, February 21st, 10:30 a.m. I know usually I do my Money Not Math coffee talks at 8:30 a.m., so I apologize to anyone who hops on here live or watches this at a later date if you were hoping to join me at 8:30 a.m. For the scheduled change. However, it's a great day. It's beautiful outside. I don't know about you guys, but the fact that it's February 21st and it's like, I don't even know what the temperature is, but 33 degrees above freezing, it's glorious. So continue the weird winter. With that, as always, this is my Money Not Math Coffee Talks, which is my goal to provide free value to you, those who are willing to show up and have a conversation and ask questions. Ideally, I would love to just answer questions for an hour. That's what I have the time allotted or booked for, is from 10:30 to 11:30 today, typically 8:30 to 9:30. However, if there aren't enough questions or enough engagement, I'll just cut it off after about 30 minutes. So with that, I will just make sure that we're not just staring at each other. I'll kind of jump into some, I think, valuable planning information or articles, and then ideally while I'm talking, someone that's watching will ask a question in the comments, and then I will redirect from what I'm reading, and I'll answer your question directly if there is one. So with that, we are going to talk. First thing I just pulled up, I got a few things prepared here in case there aren't questions from the audience or if no one wants to stop by. If you ever want to stop by my office, I'm happy to give you some free coffee and enjoy it that way too. I think in-person conversations are still the best conversations. So the first thing I want to look at today, unless we have any questions, is the most recent newsletter that I received from my business partner Ross. Just for those who are interested, we've made an investment to provide constant newsletters and planning information to both our current and not our current clients and people who aren't our clients that are interested in just free information, daily reading or weekly reading on planning concepts, things to be aware of, and things like that. Because we believe the more value we can provide our clients and other people in the world, the better, the bigger impact we can make, and that's the goal, right? Is to help people. So, with that. This most recent one that he sent was on the 13th, and it says missing out by not talking finance. And I think this is an important one because I find that everyone has to deal with finances, but most people don't want to talk about them. So it's tough to deal with if we're not willing to talk about it, right? Just like whether it's our health or anything else. If we ignore the issue doesn't go away. So missing out by not talking finance. When this is, again, the article, this is not my words, I'm reading something, but when was the last time you talked about money with anyone? If you're like most folks, you're not having these conversations much, if at all, and you'd rather talk about death or politics than money. Well, maybe that's not true anymore. Politics seems to be both the most divisive thing in the world for the last 8 years, but I digress. Like he said, if you're like most folks, you're not having these conversations much, if at all, and you'd rather talk about death or politics than money. Sound familiar? Even if that's not you and you're somewhat comfortable talking money, the more you have these conversations, the better. That's because talking finance with a spouse, kids, or friends can give you new ways to think about money. It can also shine a light on misconceptions and be a powerful source of support if you're struggling with financial decisions. And these talks don't have to be about heavy topics or earth-shattering choices. Small daily talks about money can touch on retirement dreams, funny money lessons, or some new financial fact you've learned. That's just one daily action that could be hugely rewarding in the big picture. The truth is, most of us have a hard time accomplishing our goals. We have high hopes and we tend to like the long shots, but when we're setting goals. That's okay, but it won't help us make progress or cross the finish line. What can do that, however, are small, consistent actions we never give up on. So I think that's a really valuable lesson. Like I said, it's not about making these big grandiose goals and then never following through on them. It's more important to have consistent conversations with someone you trust and building a plan so that you can achieve those goals. Now, I think all of these newsletters are extremely valuable, and if you think that little just couple-minute reads would be helpful for you on a weekly or daily basis, I will include the link to sign up for our newsletter in the comments section, so you are more than welcome to utilize that if you are interested. But, of course, no pressure. It's completely free. By signing up for the newsletter, you're not signing up to work with us. So, is there any questions, comments, concerns from anyone? Seeing none, I'm going to jump into the second article I had prepared here just in case. It is from Dimensional.com, which is one of the companies we use to build our custom portfolios for our clients. and it is a downloadable client-approved PDF. So if you like what you hear here and you'd like your own copy to read through it again, just reach out. I'd be happy to send it to you. The title of the article is The Next BlackBerry, and is written by Wes Krill, PhD, Senior Investment Director and Vice President of Dimensional, and it was released on February 16, 2024. He says some investors attribute the Magnificent Seven stocks dominance to a winner-take-all environment, winner-take-all, in which a handful of companies achieve sufficient market share to hinder competition. In business where gaining users drives success, establishing a strong market share may be like building a moat around profitability, but that doesn't guarantee these companies can stay on top. Think about the state of mobile phones 15 years ago. In all likelihood, you would have been reading this on a BlackBerry. Such was that device's entrenchment for mobile business communication. Then along came iPhones and Androids, and suddenly BlackBerry's foothold was eroded. And I can speak to that. I had a BlackBerry once, and I thought it was the greatest thing ever. The little rolling ball made it really easy to play the Brick Breaker game. Don't tell my science teacher. So anyways, continuing on, they show a picture of a BlackBerry trailing 12 months sales per share. Excuse me. So on June 7th, when the iPhone debuted, the BlackBerry was about a $5 share. In September 2008, Android debuted, and BlackBerry had about $10 per share. March 2011, Android surpasses BlackBerry in U.S. smartphone market share. September 2011. Oh, got some mail here. Thank you. Have a nice day. Yep. All right. Sorry about that. So anyways, September 2011, BlackBerry's trailing 12-month sales per share was $39.62, significantly up. So it looked like it was dominating the market, but like they said, and as we know today, BlackBerries don't even exist, I don't think, and iPhones and Androids basically dominate the market. So continuing on, the point he's making is history is littered with examples of household names that were usurped by the next big thing. Remember, Sears was a top 10 size stock in the United States once upon a time. AOL was synonymous with internet access in the 1990s. And in 2003, the most popular social media network starting with the letter F was Friendster, not Facebook. Even the biggest companies have uncertain futures, highlighting the need for broadly diversified investments. And even if these companies stay at the top of the market, that's no assurance higher returns will continue if their success is expected. So the most important point with this, hopefully that's clearly made, is just because a stock is extremely safe and big and powerful today, it doesn't mean it will be in 10, 15, 20 years. Just like the BlackBerry was the cream of the crop 15 years ago, it doesn't exist today. Just like Blockbuster used to be the place to go rent your DVDs, and then along came Netflix, and now it's gone, right? So there's so many examples of this where just because history says one thing or today says one thing when it comes to a stock or a company's value, it does not guarantee that that's going to continue in the future. So it's extremely important that we diversify our portfolios and take advantage of the whole market. Because what do we know about the whole market? Assuming the world doesn't end, and assuming we invest with an optimistic mindset, which I always do, the market's going to keep growing. Countries are going to keep printing money, and companies are going to keep driving revenues. So the market itself will continue to grow over a long period of time, we expect, right? We can't guarantee it, but we expect that. However, each individual company has less chance of continuing to grow because there's always going to be these instances where a company like AOL or BlackBerry or Blockbuster or name anyone, Sears, are huge at one point and all of a sudden they disappear because the markets change, competitors come into play and things like that. So am I saying Apple will crash? No, I'm not. I don't know that. But am I saying you shouldn't have probably more than 10% of your portfolio in any one company? Probably. So I think that's a really important point. And then for those who are wondering, I know that the Magnificent Seven stocks are just thrown around like everyone should just know what they are, but it's not that obvious to everyone. So just so we're all clear, the Magnificent Seven, as they've been coined the last 5 years because they've basically driven the S&P 500 and driven the Dow, which is an important point to know because if you're investing your portfolio in like the S&P 500 index and the Dow index and the NASDAQ index, you may not be as diversified as you think. The biggest companies in each of those indexes that control the most share in each of those indexes will likely have a lot of overlap, so you're probably not as diversified as you thought you were. So anyways, for those who are wondering, the Magnificent Seven, as they refer, are Apple, Microsoft, Amazon, Nvidia, Meta Platforms, Facebook, Tesla, and Alphabet, which is Google. So hopefully that was helpful or interesting. Any questions by anyone who's on and watching at this moment? If not, I will continue on to the other story I prepared. And again, like I said, if you're interested, I'm more than happy to download and share that to you. Actually, I think I can. Here's a link. I don't know if it'll let you download it because I have to have an account at Dimensional, but here is the link to the article I just read. All right. So the next article, if there's questions, please ask them. I'd much rather answer your specific questions than just read what other people think is interesting. But since I don't see any, I'll continue on. The other article here that I had pulled up is from Morningstar.com, which is a free website that is relatively unbiased and provides a decent amount of free information about stocks specifically. However, be very aware, it's a very credible company, but a lot of their content is still opinion pieces. It's not written by people with a legal license to give advice. They're just writing an opinion to sell advertising, okay? So always be aware of where you're getting your information and what licenses are being held by the people giving them to you. It'd be like taking medical advice from a pilot or taking flying advice from a doctor, right? Just because someone has credibility in their profession, it doesn't mean they have good advice. So here's the title of the article: Are higher for longer interest rates back? The path suddenly isn't, and this is written by Sarah Hansen, and I don't see any sort of designations or licenses, so again, this is more than likely an opinion piece, but I thought the title was intriguing. So the path suddenly isn't so clear for the Fed and the bond market. Forget about an interest rate cut in March, and maybe May too. Unexpectedly strong economic data has investors scrambling to recalibrate their expectations for the Federal Reserve's next move. According to John Briggs, global head of desk strategy at NatWest Markets, investors still anticipate Fed cuts at some point, but they are questioning their timing and they're questioning the pace. End quotes. That change has profound implications for the bond market and in turn stocks. Yields are once again ticking up as the bond market stalls in the wake of the blistering rally in fixed income that closed out 2023. When the Fed's higher for longer philosophy seemed to disappear in the rearview mirror, that outlook was good news for investors in search of yield, but it also took a toll on equity and bond prices. Yields in the 10-year Treasury note peaked just under 5% in October before falling back down to 3.97% by the end of December as investors began to anticipate rate cuts. Until very recently, yields had bounced between that low and a high of around 4.2%. So those who are wondering, a yield is kind of like a dividend or just like the payment they're paying you, because by owning a bond, you are loaning your money to them, so they're paying you for loaning them their money. It's like the reverse of what a bank does oftentimes when they loan you money to buy a house or a car. So in this case, by owning fixed income, you're loaning them the money, to put it simply. So, but now the momentum is shifting again. The yield on the 10-year note hit 4.32% this week, its highest level since mid-November. After a strong 2023, the Morningstar United States Core Bond Index is down 1.83 since the beginning of the year and 1.66% over the past month. We're in this in-between, Briggs says, where it's not quite as low as we thought for longer. In general, analysts expect yields to land somewhere between the highs we saw before the financial crisis, when yields above 4.5% or 5% of the 10-year treasuries weren't at all out of the ordinary, and the rock-bottom lows of the years before the pandemic, when the 10-year yields rarely cracked 3%. Strategists at Wells Fargo are forecasting that the 10-year will end 2024 with a yield of 3.6%, while analysts at Northern Trust are projecting a range of 3.75 to 4.25%. A soft landing is no longer seen as a certainty. It wasn't all that long ago that bond futures markets were pricing in between 6 and 7 rate cuts for 2024, with the first expected to come as early as March, even as the Fed itself projected cuts of half that magnitude. Expectations are a different story today. Jack McIntyre, fixed income portfolio manager at Brandywine Global, explains that what we're seeing now is this kind of wrestling, as the market struggles to come to terms with the Fed's view on the likely path for rates. In the middle of 2023, investors steeled themselves for a prolonged period of high rates after one of the most aggressive monetary policy tightening cycles in the Fed history. Then, in the third quarter of last year, sentiment shifted dramatically to expectations of significant rate cuts in 2024. A looser policy makes it cheaper for companies to do business and stimulate economic growth. and it tends to boost the prices of stocks, bonds, and other financial assets. But a recent spate of hot economic data, including January's blockbuster jobs and inflation reports, has thrown cold water on the optimistic outlook. An increasingly hawkish commentary from the central bank officials has stoked investor concerns. So, this is getting really in the weeds. I apologize. I was hoping this would be more big picture than super in-depth numbers, but if for those of you who are analytical like myself and like the in-depth stuff, this could be entertaining. For the rest of you, hopefully you're not getting your eyes glazed over at this point. However, since I started the article, I feel the need to finish it in case there's some really valuable news here. Hopefully they wrap it up with some more conceptual value shortly. But continuing on, in general, analysts expect yields to land somewhere between... Oh, I already said that. A soft landing is... Oh, I said that too. Sorry. A recent spate of hot economic data, including January's blockbusters... How did I lose my place? I bet. Okay, I'm going to skip to the next part. I apologize. This is the issue with going live and then scrolling and forgetting where I was at. All right. Investors' interest fades in long-term bonds. The strong inflows into the bond market over the past month are also in play. In January, as bond investors looked ahead to lower rates and inflation, many rushed to lock in longer duration investments, bonds with maturities of 10 years or more. There has been a healthy supply to meet this robust demand, with almost $200 billion of investment-grade bond issuance in January, with the busiest day of trading in history occurring on January 31st, wrote Katie Nixon, Chief Investment Officer at Northern Trust Wealth Management, in a recent note. All that bond buying in January pushed yields lower and prices higher. You had this overall thematic move into fixed income, Briggs explains. However, that was followed in February by a major reset in expectations that Fed cuts may be coming later that may have reduced demands for bonds and helped send yields recently. So I'm going to make this point here that hopefully is valuable. In all of this marshmallows or all the weeds of what I just said, and that would be really tough to follow if you were just listening. So again, I'll include the article if you want to read this and look at the in-depths. But the most important thing I can pull from this that hopefully will provide you value is all of this stuff has happened in the past, right? They're analyzing all the things that have already happened while pointing out what they thought was going to happen isn't happening. So what does that tell us? Two big things. First, for anyone that reads what's happened and makes decisions on, oh, I should get into fixed income because fixed income just had a great quarter, or fixed income was just at its highest rates, I should get more in fixed income. The problem is that already happened, right? So you're riding the wave that already has happened, so therefore you're not getting the great yields they got, you're getting what's left. And for all we know, big investors might be getting out, so you're actually buying what they're selling, which is not the right time necessarily to get in for them. So following old news for your future allocations is rarely a good plan to make. The second thing that's important to note is they're admitting that what they thought was going to happen is not what ended up happening, which is again why projecting or guessing or conjecture when it comes to investing is so dangerous. It's so much more valuable to have a strategy that fits your needs, your goals, and your ideal outcomes than it is to try to guess what you should do based on what has just recently been done. Because what has recently been done does not accurately predict what's going to happen in the near future. At the end of 2023, we all expected a bunch of we expected the Fed to cut rates this year multiple times. Now we're not so sure, right? So if you made a bunch of decisions based on that and that doesn't happen, that's potentially a risk. So hopefully that's helpful. So are we back to interest rates being higher for longer? Last fall, investors, and this is also important for interest rates, not only impact your investing when it comes to fixed income, but also impacts like buying a home for mortgage rates, buying a car and what rates they're offering. You notice that when interest rates skyrocketed and car companies still needed to sell cars, that's when they started offering like bigger kickbacks for buying new vehicles or lower internal interest rates because they still need to sell vehicles, right? So it's amazing how what the Fed does has all these different little impacts on the way we live our lives. So last fall, investors had just come to terms with the higher for longer regime for interest rates. Today's rate environment may prompt feelings of deja vu, but analysts say there are few critical differences now. For one, progress on inflation means real policy rates are meaningfully tighter than they were 6 months ago. It's not where the Fed wants to be, says Gilliam, but it's headed in the right direction. Rates may end up higher than what the market originally priced, says McIntyre, but it's less likely they'll end up higher than what the Fed is anticipating. So as of right now, or as of February 14, 2024, the federal funds effective rate was 5.33%, the 2-year Treasury yield was 4.56%, and the 10-year Treasury yield was 4.27%. So, what's ahead for bonds, they ask. Some analysts say the bond market's recent repricing, while painful in the short term, may not be the worst news for investors. Markets were overly aggressive with pricing and rate cuts, Gilliam says. As a result, he believes the recent backup in yields is warranted. Now markets are fairly priced. So that's one thing we always have to know, whether when it comes to the markets and just simple supply and demand economics, the pendulum always swings too far before it corrects. And then for a very short period, it's balanced, and then it swings the other direction and it's unbalanced, and then we realize it's unbalanced and it swings back to being balanced, and then it swings back again, right? It's never completely stationary, which is why the market will always do this. It's never just a flat line. Whether you're talking about stocks, equities, fixed income, bonds, and CDs, whatever it is, there's always going to be a swing. So that's where we can get painfully upset if we're expecting future returns to be the exact same, or future prices to be the exact same as the ones that we just felt or saw recently. The good news, he said, of course, that doesn't mean there aren't risks in the horizon. The most pressing one is that inflation could remain too high for the Fed's liking. Inflation is the nemesis of the bond markets. It's also the nemesis of your pocket and people who have a fixed income in retirement. McIntyre says, Briggs adds that markets aren't priced for a higher inflation environment where the central bank doesn't end up cutting rates. That's a major problem for everything. The good news, fortunately for bond investors, a world without rate cuts isn't the base case for most analysts. You've had a lot of progress on inflation since last fall, Briggs says, and the outlook for fixed income is still good for over the next 12 months. And if yields do stay higher than expected, it won't be all bad news. The value proposition for fixed income is not falling rates, Gilliam says. It's a high income. Even if rates don't fall from current levels, we think fixed income is still a pretty attractive allocation. You'll still collect your coupons and your organic price appreciation. And if yields do come down, he adds, bond investors can expect some price appreciation on top of that. Until we have more clarity on inflation, McIntyre says, investors can look to the bond coupon to offset any volatility and price depreciation in the market. History is on investors' side too. Historically, when the Fed is cutting rates, particularly after tightening rates, treasuries do very well the vast majority of the time. So I think all of that's really important, and I know that different people have different opinions when it comes to fixed income and bond allocations to their portfolio. I'll just say this, that if you are very, very far from retirement, like 10 plus years, investing in fixed income, though it may give you peace of mind from a safety standpoint because it's more consistent than the market, which we might do this, over a long period of time historically, the bond market has returned about half of the equity market. So if your goal is to maximize your growth and maximize your returns and maximize your retirement portfolio value over a long period of time, equity is still going to likely be a better play for you as long as you can emotionally handle the ups and downs, okay? So then for the next trading week ending February 16th, this is a little outdated, the morning U.S. market index fell. Oh, sorry, this was last week, yeah. Okay, we're not going to worry about that. Is there anything valuable in this article? Okay, so like I said, that was way more in-depth than I normally like to get, especially in a presentation. So I apologize if that was boring, but hopefully for those of you who are super in-depth, especially DIYers, or just curious people that are really analytical, that will provide some value in learning opportunity. And I did include the link in the comments. So with that, any questions, comments, concerns, or remarks on anything I've said today, or any questions that you came in with if you are in here live with me? If not, I got one more that I wanted to go through that I think is valuable, and then I will wrap it up at about 11 o'clock. Since if there are questions, I'm happy to stay on until 11:30. But if I don't get any questions here in the next 5 or 6 minutes, I'll wrap it up. So Here's another article that Ross sent that I think is extremely important. I think it's so important. This might be the most important when it comes to our personal happiness and financial success. The difference between want and need. All right? No one likes to have this conversation. No one enjoys this conversation, but it's an important one. One of the most challenging personal financial issues we all face is an ever-expanding definition of need, right? So it shows a circle that says, that's nice, I want, I need that, I must have that, that's nice, I want that, I need that, I must have that, and repeat until happy. The problem is happiness does not come from getting things we don't have. It comes from recognizing and appreciating things we already have. In human nature, every time we get something, we really, really appreciate it, the shiny new object, for like, everyone's different. 3 days, 3 months, 3 years, and also we're bored with it, and we want something new. Right? My wife and I are going through that right now. We bought our house in 2019, loved it, appreciate it. We still do appreciate it, but now we're like, we kind of like to move and to get it more space. In perspective, my mom, I think my parents grew up in like 2 or 3 bedroom houses with all their siblings, and they were just fine. But yet in today's world, we're like, hey, more space, more this, more that, right? So it's always this give and take of what do we want versus what do we need, what are we already happy about versus what do we need to get to improve our happiness. It's a conundrum, right? None of us are perfect. But the point is, the better you can get at separating want versus need, especially when it comes to your finances, the more successful you're likely going to be, because it's going to allow you to keep more of your money rather than giving it out to all the people trying to sell you stuff. All right, so continuing on with the newsletter, things we once thought of as clear luxuries somehow become necessities, often without any consideration of how the change in status happened. Cars that seemed just fine a few years ago now seem old-fashioned. Remember when the idea of giving a kid a cell phone, much less an iPhone and iPad to boot, seemed outlandish? Of course, I can't help but ask the following questions. What if financial happiness is not about getting more, but about wanting less? What if things start out as wants and become needs, not because the things themselves have changed, but because our feelings about them have changed? What if you can never really get enough of something you don't need? Look, we all know that the shiny new toy we needed to have often ends up in the pile of things we need to sell at a garage sale or donate to charity someday. This is yet another example of why personal finance can be so complex, because there's no definitive list of 100 things that every family must have. So these decisions end up being incredibly personal. But don't despair. Over the years, I've gathered a couple of righteous tricks from personal experience and feedback from folks I trust to help draw a line in the sand between want and need. Try the following. First, don't buy things immediately. Sleep on the decision overnight. Pro tip, this works for e-shopping too. Before I buy a book on Amazon, it has to sit in my cart for at least 72 hours. This is so important because what we have to understand, if you didn't study marketing or psychology, all of these companies, including Facebook, which I'm on right now, spend billions of dollars or millions, depending on the size of the company, every year understanding psychology and marketing and how to manipulate our emotions to get us to impulse shop and impulse purchase their products. Step 1, make you afraid of something or make you insecure. Step 2, make you think that they have the solution to fix your security or unhappiness or your fear. Step 3, make you think that by buying what they're selling you, you will solve your issue until the next time they want to sell you something, right? So it's kind of like I always thought it was funny growing up how every 6 months you'd see a new cleaning product come out that said it kills 99.9% of all germs and it kills like 10 times or 2% more or whatever more than the last product. And then 6 months later, a new product would come out that says the exact same thing. At some point, these products can't all get killed 99.9% of germs and be 10 times more effective than the previous product. Like, it just doesn't make sense, right? So that's kind of a simple example. But point is, don't buy things immediately. Sleep on it. Try to let your impulse and your emotions wear out and decrease their manipulation on you. So, number 2, implement a stuff quarantine. Nothing new comes into the house without sitting in the garage for 3 days. Then, if you still feel like you need it, it comes in. Otherwise, it can be returned to the store. I've never tried that, but I bet that would be really effective. Use number 3. I've been trying to convince my mother, my mother-in-law, and my wife of this for years. I don't know if any of them agree with me, But this one's a good one. Number 3, use the one in, one out rule. For every single thing you bring in the house, one thing has to go out of the house and not into the garage, far, far away. You can do this with books, clothing, anything. The important thing is to engage in the process of trying to get clear on the difference between what you want and what you need. Put some space between yourself and the impulse to buy, and use that space to reflect. That one is just, I would love to live by that all the time, because it would do 2 things. First, it would make sure your house never gets cluttered. I love space. I don't like a ton of stuff everywhere. And second, it would force you to really think about, do you really want to buy this? Whatever this is. It could be a new phone. It could be a new tumbler. Remember when these were like the hot thing that everyone needed to get, and now we all have 25 of them, and we probably donated 15? Because if you know you have to get rid of something, you might be more likely to take a second guess of, okay, if I'm going to buy something, what am I going to get rid of? So, things to consider. Overall, whether you try those 3 things of don't buy things immediately, implement a stuff quarantine, or use the one in, one out rule, it's extremely important to just remember, the better you can get at differentiating wants versus needs, the more likely you're going to have financial success in your future. Because remember, I've sat down with people who make $400,000 a year and they're still living paycheck to paycheck. So more than often than not, it's not an income problem, it's a discipline or a how much money you're keeping for yourself problem. All right, so any questions, thoughts, comments, concerns, or remarks from me, please throw them in the chat. I'd love to stay on for 29 more minutes answering your guys' questions specifically, but I'm not going to stay on for 29 more minutes just reading other articles. So, seeing none, I'll wrap it up by just saying thank you guys so much for your time. Thank you for those who show up live on a weekly basis, and thank you for those who check this out later on. As always, it's important for me to remind you that this content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation. If you want my legal advice, we have to sign contracts and things like that for me to actually be your fiduciary advisor. So have a great day. It's, again, beautiful outside. Hopefully you enjoy yourself, and hopefully you can find a golf course open soon. If you live in Thief River Falls area, hopefully we can be open for you soon too. All right, have a nice day. Bye.